I'm Chris Park, a co-founder of DeFinity, and the larger group I sort of fulfill the role of CFO as well. My background is probably 20 odd years in investment banking, so everything from leverage finance and private equity through to trading, structuring, derivative sales, and so on. A few years ago, joined up with Manu and the rest of the members, and we sort of started DeFinity, building on DMA Link's great FX franchise and all their banking relationships. We've been on this journey to provide this full institutional service that recognizes the difference in digital assets and crypto from TradFi assets, but enables financial institutions to come and trade the same way with all the right controls and checks that they would need, but to be able to trade into crypto and digital assets. Bigger asset managers, pension funds, and financial institutions have got a lot of guidelines and regulatory frameworks around them as to how, where, and when they can trade. And a lot of that's about regulation. It's about the credit counterparty. It's about investment rated companies. It's about segregation of the key factors of a trading venue. So segregation of custody, settlement, execution, which provides protection to the asset owners' value and assets.
Most people are only aware of institutions being able to buy crypto essentially through ETFs. What is it that's different that DeFinity is doing?
There are one or two global players who seem to manage to straddle so many jurisdictions that nobody's quite sure who to please. So we'll say remain nameless at the moment, but there are one or two people that tend to do what they want. But pretty much every asset manager, hedge fund, etc., below that has a set of rules and criteria they have to fulfill. And one of the biggest things that's been holding back the growth of institutional crypto has been the credit quality of the institutions. So after the financial crisis and TradFi, there was a far, far greater lens shone upon how banks and funds traded with each other and what risks they were allowed to take and what supported those risks to basically stop a repeat of the systemic problems that happened in the financial crisis. So that means those rules then have to be applied to all asset classes, including crypto, for them to hold it directly. And what we have done with the regulation out of Jersey and with the tier one investment bank that we've partnered with from a credit intermediation side is actually we've given them access to trade crypto through our venue, but they can choose their own custodian. They will trade through us and we will bring them prices from multiple liquidity providers, which means they can demonstrate best execution, which again is something they legally have to undertake from a regulatory standpoint. But most importantly, the investment bank will actually support the credit of the transaction. So in layman's terms, it means if the person they're trading with trips over, the investment bank will step in to make whole that trade with cash or bond collateral that was deposited at that investment bank at the beginning of the relationship. So this means they're basically trading against cash credit risk. So that means that they can actually scale up their trading opportunity. Now, because we're regulated, because we've got the investment grade credit backing, that means they don't have to be forced to go down through the ETF route and pay the high annual fees that these big providers are giving them, because that's basically just giving them a wrapper, which is a slightly inefficient way to trade, but it's giving them a wrapper that ticks the boxes that we have managed to tick for them directly. So they can enter the cash market without breaking any of the rules that they're bound by. We've applied an awful lot of the technology, a lot of the legal frameworks, and a lot of the expertise that we understood from TradFi assets. And then we've also recognized the difference for digital assets and crypto. And basically, we blended the two together to sort of make the inflection point. And that's really what our secret sauce is. We're not trying to treat crypto like a TradFi asset. We're not treating it like a stock or like foreign exchange currency. Likewise, we're not pretending that institutions can come along to a DEX and just play around like you or I may do. So we sort of brought both sides to the middle so that the institutions can come without breaking any of their rules, can come along and they can enter the cash crypto market without having to pay the big ETF providers these really high fee charges that they're applying just for giving the privilege of access to the market. Jersey as a jurisdiction is very funds focused, and that was one of the reasons we chose it. It's obviously close to the FDA, which is close to the SEC, etc., but it's very funds focused. So it's very focused on growing out asset management, alternative areas of investment, and that's all the sort of stuff it's working on. So by bringing Jersey in, which is a credible jurisdiction, we're creating a venue that is usable by these global players. Because we've been working with banks and financial institutions, large hedge funds, with regulators and so on for so long, we've got that trust and knowledge and relationship that's long-standing and already existing. If you imagine DMA doing foreign exchange, DeFinity doing crypto, well, actually, to them, it's just, okay, I already trade with you in one asset class. I'm happy with what you do there. I now just add on another asset class. To them, they just see this as an extension of the service we're already giving them and they're already happy with. And it looks and smells like the way they will normally trade. And that's the key thing. We're not trying to get them to learn new tricks. What we're doing is we're giving them the new asset class, but we're giving it to them in a flavor that they're already familiar with. And again, that's been the key. When they see the legal documentation, when they see the bank counterparties, all these things, they're all familiar, which means that as well for us, the time to get them on board and to get them up and running is also a lot faster than a crypto native only ever been in crypto participant to come along. And their compliance and legal teams have told us that it's now impossible for them to onboard many of the crypto names just because they can't get them through the process. So the margins for foreign exchange, for example, are tiny. Yeah, there's no getting away from it. But it's a big market. It's like $7 trillion a day of volume. All right. So that's a lot of change going across the desk. So even though it's very, very small margin, because the numbers are so big, you can still earn a crust. Let's put it that way. You can still make a living, even in a very small percentage of 7 trillion a day. The crypto market is much, much smaller. Yeah, it is significantly smaller. However, and it's hard to get an exact gauge on it because lots of different sources look at different areas, but it's at most 1/10 of the size. It's current estimates. But one of the things that we have found is even though it is smaller, the number of big established players that are monopolizing it are far fewer. But to your exact point, the margins are significantly greater. And we're talking in many cases a multiple of double figures, and in some cases potentially even up to 100x of what you would expect to see in foreign exchange. So even though the market's slightly smaller, what we're bringing to market and the fragmentation of the market as it stands means there is a much bigger opportunity for us. And also just on every dollar that transacts across the platform, then we're seeing significantly higher margin opportunity in terms of actual revenue. So how much margin do we generate from the big number of flow? Then that number, crypto is screaming ahead, and it will be significantly the biggest proportion of our business from a revenue perspective going forward. It is huge. And the reason is a lot of the people that we've traded with before, the significant proportion, and actually our investment banking partner as well, a lot of their clients that are very keen to get into crypto have struggled to do so because of all the rules and regulations we've been talking about. So I would sort of say we think there is a significant pent-up demand. These people have not been able to break into cash crypto, but they know that they have to because the size of the asset class means they have to include it in their basket. So it's moving in that direction in terms of the people that are already trading assets with us or with this bank that want to move into crypto but haven't been able to touch it so far and have been sitting in the sidelines. We've got a very strong pipeline, both of our own and also for other people coming in. So I think that for us is very exciting. And what's lovely is that other people in the ecosystem, people that we already work with, are saying, we know people that are desperate for this. So it's not even like we have to go out and find people to trade with. We know where they are. It's really just opening the taps for them. And again, that's significantly different from, foreign exchange, existing asset classes. People have got to go out and justify and work. Here, we know there's a whole group of people that are desperate to either enter the market or to reduce the cost of being in the market because of the high fees that ETFs charge on a recurring basis. We spend a lot of time not just with the Jersey regulator, but we've also spoken to UK regulator. We've spoken to people in Europe. We know the SEC at the top level. So we spend a lot of time because we recognize that actually for the institutions to come in, you also have to try and create an environment that works for them. And while people are writing the rules, it's better to get into the room with them and try and help educate them and shape the way they write the rules. So then as the bigger economies formulate their regulation and rules for digital assets, then you've helped them shape them in such a way that will work. If you can get into the room with these guys and just tell them how things could work in a sensible way and help move them in that direction, then I think that's also key. Because regulators, in many cases, many countries have put their hands up themselves saying, we don't really understand this. So we know we have to regulate it, but we don't quite know how. So helping them understand how to regulate it also helps us make sure the regulation is something that's workable for the industry. Beyond this, we know that the banks are already starting to look at ways, and they're already creating platforms to put things like fixed income bonds onto blockchain rails. And the wonderful thing about crypto and about blockchain is there's a far greater ubiquity between asset classes. The way banks operate ridiculously is in silos. So they have, fixed income, so bonds in one place. They have equities in another place. They have foreign exchange and commodities sort of sitting in another bucket over there. But actually going between those silos is very difficult, very clunky, and uses up lots of banks' balance sheet, and there's a lot of frictional cost. The great thing about crypto and blockchain is it's demonstrating that there's a way to build something that starts to break down those barriers. Blockchain and crypto, how it all moves, how it works, how the transfer of value, how banks custody it, all these things are getting developed and understood, and they're growing, and the industry around them is maturing at an incredible pace. So if we then look at the fact that banks are looking to put other assets, some call it real world asset tokenization, some's on-chain assets, so direct issuance of bonds. But the big banks, the JP Morgans, the Goldman Sachs, HSBCs, the big global banks are looking at putting other assets on there. And what is great is we're a secondary venue with credit support. So once something is tokenized, then going forward, there is no reason why we can't just continue to develop our regulatory status to accommodate other asset classes beyond crypto. So crypto, stable coins, we already do foreign exchange, fixed income bonds, whatever other real world assets get tokenized. We're a venue. We're kind of agnostic in a way as to what it is. So asset managers can come along and they should be able to trade Bitcoin against JP Morgan bonds or BMW bonds. They shouldn't have to go through 5 different intermediaries to do that trade. If somebody makes a price on it, we can show it, and our infrastructure supports it. So that's what's really exciting. It doesn't sort of stop here. It keeps on going. We want to be at the forefront of all the, with the custodians, the development of that, our recent partnership announcement with HEMA, the settlement solution that we're looking at. So how do we have a cross-chain custody agnostic settlement solution that sits behind our venue? So we're looking at work around that. We're working with them to see if we can get a zero knowledge proof smart contractless settlement solution that is cross-chain applicable. We're doing our best to work with people that we believe are creating new and exciting and innovative solutions to some of the problems that exist in the industry. And as the industry grows and expands, we're part of it. So we've not built a boat and we're sitting waiting for the tide to come in. We're actually working with people to make sure that we're helping the entire industry to develop and mature, which then makes our product have a greater growth opportunity and more applicability. One of our strategic partners, they have 7 regulatory licenses including a banking license across much of Asia, dealing with consumers. So they're B2C. And we're a strategic partner because we're working with them on the B2B bit that they then take to C. So we're basically providing them access to the big liquidity and so on. So even though we're an institutional partner and we won't have a billion customers because there aren't a billion financial institutions in the world, some of the people that we're working with are targeting massive parts of the global population. And we'll be sort of standing there helping bring the liquidity, helping bringing the structure into what they're taking forward to mass markets. What's been great about crypto is when a market gets mature, it's all about cannibalization. So if your market's growing 7-8% a year, but your target's 30, yeah, you're going after somebody else's lunch. That's the way you've got to do it. So you're often maybe adding value to clients, but in many cases, you're just going to cannibalize the existing market. Because the crypto market, the way it's been growing, and in the institutional side, a lot of the participants have realized that by working together, I'll call them frenemies. So we're not talking about people that do exactly the same thing as you, but people who do something that might be a little bit sort of competitive. And that was very much the way we sort of started with One Trading. Recognized that there was a small overlap in the Venn diagram. So our customer bases were touching a bit, but we were going in one direction. We were developing a product, and we were working with a customer base that were a different target demographic from what they were doing. But by supporting and working with each other to help develop our products, our liquidity, our market capacity, our capabilities, it meant that we both evolved faster and moved faster down our paths. And we're now very much moving in different directions. So they're out of Amsterdam. They are a derivatives exchange. So they can now market crypto perps to retail investors. So nothing like what we're doing. It's derivatives and it's retail and it's in Europe. So nothing like what we're doing at all. But we've known them for a couple of years. We've been working with them. We've looked at things, for example, the anomaly detector, risk management, trading partnerships, all these sort of aspects, recognizing that we can provide and supply things into their business model and vice versa. So it's a symbiotic relationship.
I love that story. It shows that you can get more flies with honey than you do with vinegar.
It's a great opportunity for people who are not institutions themselves, but who want to participate in the institutionalization of crypto to come along for the ride. And that's something that is quite difficult to achieve. Often what happens is when the big financial institutions come into a new asset class or a new industry, they often take all the toys and then take them back off and play amongst themselves in the corner. And they kind of freeze out the early adopters. They freeze out the people that started the industry and kind of hoover everything up and run off themselves. We're doing our best to make sure that the people that started this industry and the people that are interested in this industry at a grassroots and at a retail level can come along for the journey and participate, even though the big boys are coming into the room. The advantage is we understand how wholesale markets work, and therefore we're not trying to bend wholesale markets to play like crypto, and we're not trying to bend crypto to just be a dumb ticket on an asset class in wholesale markets. I think what our competitive advantage is, we've taken parts that are required from both sides of the fence and brought them together. And we've brought the credit intermediation and the regulation. And there is nobody else. People have talked about being prime brokers or investment banks in crypto. They don't have the balance sheets. Exchanges that are the central risk counterparty, they don't have the regulation. They just it doesn't exist in the market at the moment. So by deconstructing it a little bit and bringing the participants together who all have the right pedigree and the right CV, we've created something that just doesn't exist in a single entity anywhere.